My name is Marty Kerman, and thanks for joining us today. This is the first session of our Strategic Tax virtual conference. We have 4 of them over the course of the week, and we're going to intend during this session to kick it off and give you a sense of what our overall goal is in the context of working with companies in what we call a Strategic Tax Advisory Annual Review. As mentioned, it's going to be four sessions. We're going to have a number of team members, actually, who are all on this to introduce themselves today, to talk about some best practices and how their utilization of some of the latest credits and incentives and other planning opportunities benefits potentially your organization. This year, we're offering, as I mentioned, another session today and 2 more on Thursday. So we do hope you're planning on joining us for all of them. But with that said, I'm very pleased to introduce our speakers today, and I'm gonna break it up into 2 distinct sessions. The beginning of this, we're gonna focus on we'll call it our Strategic Tax Advisory Leadership Group, who are focused on, I would say, working together in order to analyze your organization and understand what opportunities may be there. But let me begin by introducing Laurel Tinsley, who is a managing director in our strategic financing services practice, Brian Dill, who is a partner in our international tax practice, and Lewis Cole, who is the leader of our state and local tax group. Later on, we're going to be joined by a few more members from our tax credits and incentives group, specifically Melinda Young, Vivian Kors, and Glenn Lemieux, who are all directors in the group. Okay, so here's what we're going to talk about today. Let me go back, sorry. We're going to talk at the beginning here about what it means to do a strategic tax advisory annual review, the benefits of that, and what some of the things that we look for that might create opportunities or red flags when we're thinking about what may benefit you holistically as we take a look at the overall tax return and see what may be there in all of our strategic tax capabilities together. We're going to then move on and turn the second, I guess, after the first half hour, we're going to begin and get into the credits and incentives side of things and talk a bit about what we're seeing in the world of R&D credits, what we're seeing around the requirement for capitalization that began in 2022 under Section 174. We'll get a little bit into some of the Inflation Reduction Act and the energy incentives, and that's almost a primer for a later session that comes on Thursday, where we're going to get pretty deep into what's going on around the purchase of tax credits. I think that'll be a great session. A lot of people express interest in that. We're then going to talk a bit about what's going on in real estate and construction and some of the incentives there, specifically around cost seg and 179D and the updates the Inflation Reduction had there. Glenn Lemieux is going to talk there a bit. And we're going to do a little preview of some future sessions as well. Again, that due diligence that we perform on the purchase of credits, some a little sneak preview of what we're going to talk about with site selection and new markets. And Melinda Young and Laurel Tinsley will be speaking on a later session later today on that. Okay, so with that said, let's get into it a little bit. And again, here are the 4 sessions. This is Unlocking Tax Efficiency, which is strategic approach to maximize savings and compliance. The purpose of the session really is to talk about what our approach is as a firm to our strategic tax review and how that goes and how we work on that together. We're going to hear a bit now from Brian and Lewis and Laurel with me to talk about what we're doing and how that works. Later, session 2 is the importance of your business location. That will be Melinda Young and Laurel Tinsley. Session 3 is Thursday. I think this will be a very interesting one with Brian and with Lewis and some other members. Strategies for pre and post tax optimization, maximizing tax savings, sort of a nice combo of our SALT and iTax group together. And then again, this seems to be an area that, at least where I'm focused and seeing a lot of activity, is the developing market for the purchase and sale of clean energy tax credits. All right, so let's get into what we're talking about with respect to our Strategic Tax Advisory Annual Review, what it means to us and what we hope it can mean, I would say, to you. Okay, well, say that, yes. The intention of it is to bring together all of our strategic tax teams, really to provide a holistic review of what the company's operations look like, and not just focus on one particular incentive or one particular driver, but really see how everything works in combination. Say, for example, you have Section 174 capitalization. Okay, well, now taxable income's increasing. So what do we find to counteract that? Well, both identifying credits and also like finding opportunities for additional depreciation. Where can we then move, like, for example, like a cost seg study or 170D, then where can we move on and find, hey, if you're a C Corp, maybe you want to purchase some credits. So it's looking at everything in the overall footprint of the company with a group of people who I'm proud to work with, who I think are quite adept at understanding exactly what opportunities exist. Our focus during the Strategic Tax Advisory Annual Review, clearly we want to identify federal and state credits. We're looking for cash grants. We want to look to minimize global tax rates to the extent you have a global presence. Plan for future spending to the extent you have planned capital spend, help finance that, assess your overall restructuring, and do that together over a time period where we can ask and request information in order to make that effective, and then really come back to our clients with a menu of opportunities that may be of value, or even a timeline of different opportunities that may make sense to pursue based on both current and maybe potentially expected law changes. Okay, so with that said, I think this might be a good time to begin to introduce some of my team members here. Again, I'm Marty Kierman. I'm the head of our Tax Credits Incentive Advisory Group. Where we're focused is, to the extent, are you performing any research and development? We want to understand what you need to capitalize and what credits may be available. If you have real estate or a real estate portfolio, or you own buildings or are purchasing buildings, we want to understand if we can accelerate depreciation or deductions through cost segregation. Beyond that, we want to understand if there's any energy efficiency investments made into a building, or just general investments in renewables to get either credits or additional deductions. We also take a look at the state statutory and negotiated credits, I would say currently and backward, and then also forward looking to the extent you need any site selection services if you're going to be moving your operations or you're going to be hiring. And then not too historically, but over the last few years, we did some employee retention credit work. It's pretty much done, but we are working with companies to the extent they haven't gotten their cash from the service to help understand where that is in the process, and to the extent they need any additional documentation, we're working with them there. Okay, with that said, why don't I hand it over to my colleagues to introduce themselves a little bit. The next one here is international tax. So Brian Dill, do you want to take it away and just talk a bit about you and your group?
Thank you, Marty. Appreciate it. Yes, I've been doing international tax for almost 30 years, and I head up the international tax practice here at Cherry Bekaert. We're a traditional international tax practice divided into 3/4 primary areas. We have our traditional U.S. international compliance and reporting, which has its own unique attributes because of the heavy penalty regime here in the U.S. We have our traditional transfer pricing group to help you document on a global basis in whatever jurisdiction you need your intercompany pricing. And then we have our consulting and transactions group that assist you from your research on technical issues and transactions that you might be entering into, and that we're also your connection to the world in our lineal network and connecting you with firms around the world. And I would say from an overall perspective, where we approach it from an international perspective and from that STAR approach, we take a unique approach in that what we do is we look not only at what is your financial flow or how are you recording your goods, but also as we talk about legal entities, what is your legal flow, what are your entity structures, and we cross that over with your actual physical flow of goods and services, and we're able to divide that up and help you design plans to assist you to drive your global tax rate and cash tax rates down. And that's what we do over here in international tax. Marty?
That's great. I agree with you. That is what you do. So that's awesome. Good explanation. With that said, Louis, why don't we kick it to you to talk a bit about state and local, talk about yourself a bit as well.
Absolutely. Thank you. Hey, everyone, I'm Louis Cole. I'm the national leader of state and local taxes based out of Atlanta. We have a national practice here, and we operate in 4 specific areas: income franchise, sales and use, property tax, and payroll taxes. We do a lot of compliance, and we do even more consulting associated with that. What we've noticed over the past couple of years is that Nexus is the word of the day for not only for income and franchise, but sales and use tax and all of the other taxes as well, which leads backwards towards the international tax side as well, because we're looking for a Nexus or a PE in various states as well, just like Brian Dill does from an international perspective. So looking forward to talking with everyone today as we talk about state and local taxes in this session and in the next one as well.
Excellent. All right. And Laurel Tinsley, would you like to say hello?
Hi, everybody. I'm Laurel Tinsley. I am the head of our strategic financing services team. We have a team of about 15 folks. My background was in law and in running a community development entity. And so after coming here, we've developed a team that focuses on the holistic community development from sort of start to finish. So if you are an entity that wants to seek grant funding in order to get a project done, we have a team of writers that does that work. We have a team of project finance consultants that helps people seek capital in various forms. So new market tax credit is one of the biggest ones, but lending and other types of capital to fill your project capital stack. If you're building something or need to work on, operating capital or working capital. Then we also have a compliance team, so that as the government likes to keep us all busy, compliance is really important in order to keep your tax attributes safe. So we have a compliance team that does work on all sides of the transaction to help people get people stay compliant throughout their compliance period. And we also have a strategic consulting team that helps you get into the program if you're looking and you're a little bit 2 steps from where any of those other services I mentioned sort of hit. We have a team that can help you plan the steps of getting in to the programs that we manage and monitor. So that's us, and then I'll turn it back to you, Marty.
All right. And us is really all of us together, right? So this whole group here, we're focused on federal and state, US and foreign, things that hit the tax return, things that may just be treated as financing that can provide benefits. So we're focused on as many, we're not limited by borders, and we are also not limited just the tax return in terms of some of the benefits that we can provide. So it's an exciting group to work in, and it's great people to work with. So with that said, the process really, I think, when we say strategic tax advisory annual review, I think Lewis and I have had many discussions just about sort of going back in time, our history at some of the big four in some of the strategic tax groups there. They would perform for large companies an overall what we'll call strategic tax review, where they would send out an information request, go out to the company, sit there for a week, go through the returns, go through additional data that may be available, talk to certain subject matter experts at the company, and then come back with really a menu of different potential opportunities for the client to consider. We're kind of talking about the same thing here. And I think that this particular service has not been well addressed in the middle market. And so what we're attempting to do is take our experience at larger firms and bring it here to Cherry Bekaert to work with the middle market in a way that I don't think a lot of mid-tier firms are really working with them in such a holistic way. And so that is sort of the goal of this, to not just focus on any one thing, but focus on many things that may influence each other as we're focused on providing value there. Okay, so we'll each talk a little bit here. I'll begin here talking about what some of the opportunities where we are focused are, but with respect to my group and the tax credits and incentive space, we clearly are looking to understand what a company does, whether it is product or process development or software development, whether or not that satisfies the definition for tax purposes of what is R&D credit eligible and also required to potentially be capitalized under Section 174 beginning back in 2022. there's a thin line to thread between capitalization and credit worthiness. And so our goal is to minimize capitalization as much as possible while maximizing that credit and help people plan for what amortization may be there. And then to the extent they have increased taxable income as a result of what we're identifying as true R&D that needs to be reported, find additional incentives going forward to potentially negate the negative effects of that capitalization in some of the earlier years. What then feeds into that with respect to my group is to the extent analyzing whether there are new buildings or facilities and trying to understand whether or not there is any ability to take an additional depreciation deductions under cost segregation or additional deductions with respect to like some of the energy efficiency investments that they've made as well. So we're focused on what a company's doing from an R&D perspective. We focus on what they have from a real estate holding perspective. We are focused from a I would say payroll tax perspective, just to the extent they did claim an employee retention credit in the past, how that affected their return. Did they make a potential or required reductions in wage deductions in the past and in time? And do they need any IRS defense help? Again, because those employee retention credits are delayed and may need additional documentation to the extent they're suffering excess scrutiny right now that the IRS is providing. Last point here is we're always looking to see whether or not jobs are being added. And I think that ties in well to maybe what Melinda looks at as well as Laurel here. So I may have them talk a little bit about what some of the driving triggers are and where benefit is found with respect to our analysis.
So I'll take the beginning because our job creation really is talking about typically low-income communities. So it's not just job creation anywhere for new market tax credit eligibility, it's job creation within a low-income community. And so if you have that aspect to your project, you may be able to as well for new market tax credits. But Melinda covers the waterfront of a lot of other state and local incentives, which we then put into our projects and help with the capital stack. So Melinda, do you want to talk about some of the other state and local incentives for job creation?
Sure, Laurel. Hi, this is Melinda Young. So I focus on state credits and incentives. From a job creation standpoint, when you're adding a job and you're offering insurance to these employees, a lot of time the state may offer job grants. It would be cash grant that if you hire the employee, create the job, you'll get a grant. Usually if it's between $2,000 to $5,000 per person. And if you maintain those jobs, a lot of times the state would offer statutory credits in addition to that. So in states such as Georgia and South Carolina, when you get a job tax credit, it could last for up to 5 years. And if you are located in a more distressed area, the credit could also be higher. It could be up to $125,000 per jobs.
And from a state and local perspective, there are a lot of opportunities that we look at. As I mentioned before, the word of the day seems to be nexus and nexus reviews. We find that most of our clients, as they go through even M&A transactions, some of the biggest issues come from not only not knowing where you should have filed income tax, but really the sales and use tax implications associated with that and the Wayfair decision that was basically looking at economic nexus opportunities and planning. And so we would look from our perspective, not only from on the sales tax, from an economic perspective, we would then help do the remediation associated with that. And that's always great, especially if you in an M&A transaction and they have taken some liberties to reduce the payout to your owners. A lot of times you can go back and get those funds. We can do prospective planning associated with that as well. Income franchise tax analysis is a tricky game. The planning, the states really, it's a chess match. Every time we come up with a great idea, they block it with planning associated or anti-planning, if you will, or add backs associated with that. So what we have found is that the structures that were put into place a number of years ago no longer match the business operations, or they're no longer effective. And so we help to rationalize and optimize and do the planning from the perspective of utilizing those tax attributes, specifically the R&D and jobs credits and so forth, NOLs and stranded incentives and credits, and moving operations around to not only come up with prospective planning, but rationalization of legal entities. So optimization and rationalization is the word with regard to state and local tax planning.
Yeah, thanks, Louis. On international tax, mid-market usually does not have the benefit of an entire international business division that has developed policies and procedures. So our focus in the middle market is, we help you go global, from developing policies and procedures about when is it wise to set up an entity, how much is it going to cost to operate an entity overseas, what are the administrative burdens and the tax and financial burdens that come with that. We can help you through that entire process. With that, what happens to a lot of people is that should read intangible assets. What we help people with is understand when they've actually offshored their intangible assets. It's not a legal test. In the tax world, it's an economic test. And we can help you walk through that. We have a lot of clients that unwittingly have moved their intangible assets and are subject to tax in a foreign jurisdiction. And they never realized that until they came up for an exit and it came up on due diligence. Transfer pricing, probably the number one thing on a global basis we see today. And the reason transfer pricing is so big when you go global and you're crossing jurisdictions is that if you do have an audit issue and you do have an adjustment, the downside is so very big because it usually ends up in double taxation because you're not allowed to go back and amend your prior returns in the other jurisdiction. And therefore, we can help you design a transfer pricing policies, procedures in order to avoid those things as you go global. And as I'm sure you've seen in the news, the other thing that's big is, well, what about this global minimum tax and how is that going to help? Well, we can walk you through that. It's called BEPS 2. We can walk you through those pillars. What are you going to have to comply with on a global basis? We can also help you identify here in the US export subsidies, such as foreign derived intangible income, that can decrease your rate by 10, 20 percentage points if done correctly. And also we can help you optimize when you do bring profits back, your foreign tax credits.
Right. We shall move on. Let me share my video again and we'll move on to the next slide. All right. Talk a little bit about process here. So again, I think that's impressive, and you can get a sense of the kind of things that we are thinking about when we approach a company. Every company is different, so the approach is a little bit different. Maybe we'll have other team members who have different expertise, et cetera. But with respect to our overall process, I think generally speaking, there is some form to it. And Louis, I don't know if you want to talk through exactly how this thing works, but this is what we're trying to get our clients to consider.
I do. There's some real opportunities here, and doing this, the facts really matter as you go through this process. And so phase one really starts with really a preliminary phase and the actual scoping or assessment phase. We begin by understanding internally, before we get on site, what the opportunities are, how the business is, the basic operations from income, the way you produce income in the past, all of your income streams, and go from that perspective and identify based on A, publicly available information, and then B, if we do your tax work, the tax team, we have communications with them to refine the team that we need. So as we go through this, we usually have federal individuals, accounting methods, credits and incentives, state and local, that would be income, franchise, sales and use, property, payroll, and then the international aspects of this. Define that team, bring that team in to review the data and understand everything we can about the company to begin with. Then we, with that information in hand and the team refined, then come talk with the client about, with your operational personnel, your upper executives, what opportunities are there? What things can you and can you not do right now? And trying to scope the company from that perspective. So beginning to end, it says 1 to 2 weeks. It depends on the size of the company. That includes both the preliminary and the assessment phases of that. From that perspective, then we as we get on site and we identify those opportunities and we have those functional meetings with various individuals to refine the opportunities, to then bring those to quantify as best we can in that short consolidated period of time, the opportunities by category and whether or not it's a, it's an efficiency issue, if it's a cash savings issue, effective tax rate opportunity, credits, incentives, that all of those opportunities are quantified. And as we present back to the company those opportunities, the company can then say yes or no, and we would then refine those, create a work plan, and begin in earnest to deliver the savings associated with that. Some of them are easier than others. Say it's a jobs credit, you have to do certain items, or from a federal perspective, you can do an accounting method election. That's on the easy side. If we said there's opportunities from a corporate restructuring and an entire reorganization of your company to eliminate old planning and bring new things in or prepare you for the future, that takes more, that's more difficult, but with that comes comes additional savings. So each one of these would have their own unique work plan from this, and then we would help you deliver those results, get that into your hands. An idea that is not implemented has no value, but I would also say that an idea that's implemented without the right team creates more risk for you than if you never had it. So our objective is to find the right team to work with your operational personnel to do this in a consolidated period of time and to deliver those results. This process has worked extremely well. And then as the company moves down the road, operations 6 months, a year from then, there's real, we would understand the business operations, which is, and to determine if there's additional opportunities as we see things coming before us. So, and then to do this on an annual basis is extremely valuable to the company, that as you sit there as the tax, the lead tax officer, you want to be able to talk with upper management that yes, on an annual basis, we review what we've done, the business changes, and we've got a process to do that to make sure that we're as efficient as possible from an operational perspective.
Right. Melinda, I don't know if you had anything to add or if you covered it. What are your thoughts there?
Yeah, just to give you a quick example of what we do from a state perspective. So we'll ask for a facility listing, and then we'll interview someone that's in the operation. We'll review your past spending for the past couple of years, your job creation and capital investment. We'll take a look at those, and we'll analyze your locations. A lot of the state credits and incentives are based on your actual physical address, and we'll analyze those addresses and identify any job tax credit, investment credit that may be available. And once when we get to phase 2, we'll quantify the benefits. And phase 3, we'll submit a minute return with the auditor, and we'll help you get your refunds back.
Yeah, and it's going to be a very similar process for all the potential things that we have to offer here. Okay, so with that said, let's I promise we'll get to our first polling question soon of 6. But and it does pick up a bit, and we're gonna change gears in 1 second. I'm not gonna go too much into this. We just have 4 slides about our groups, and we've kind of talked about them already. Tax credits, incentive advisory, upward of about 50 people, both who've been at Cherry Bekaert for a long period of time and those who have been newly recruited in. It's a growing group focused on R&D and cost seg and any Inflation Reduction Act credits, and also some of our state credits and incentives as well. We're going to hear more from some of the group on that today. Strategic financing services. Laurel, anything else to add that you didn't cover before we move on?
Yeah, I think I would just say that we get to know some of our projects fairly well over a several-year period, because obviously capital planning doesn't happen overnight for most people. You don't just get a grant and a gift right away. So often you're thinking about what to build and how to build it over a period of time, or we're helping people with their new market tax credit compliance and things like that. And often that gives us a view into some of the other areas that we've talked about today, and let us help bring our other team members to the table. But we're sort of one of those things that you don't need every day, but it's nice to have us when you do have a big project. So if you're thinking about either you've been a lender and you want to get some additional resources for lending, we can work with various different CDFI programs to help you get funding for your lending programs. We can help you with certifications and things like that. And I think that's probably about all I wanted to add here. So thanks.
Very good. Okay, state and local. Louis, you think you covered it or anything else to kick in here?
I think in essence of time, I think we're good to go with this.
That's wonderful. And Brian, anything else here?
Yeah, I think we've covered it.
I think so too. All right. With that said, just a little case study here. I think, and Melinda, you may be able to add some thoughts here too, but like what we're talking about is coming together and looking for a variety of incentives. And we were working on one company that had looking at its overall tax provision, and that kind of like then drove us to think about working with one of the partners at the firm here to think about a variety of different activities, or sorry, a variety of incentives that may apply to them. Kind of began or ultimately arrived at some amount of like looking at what they've done from an R&D perspective, because they hadn't looked at it in the past. They hadn't thought about capitalization back in 22. They had recently gone through some acquisitions that sort of changed the overall structure of the group to put it in a more taxable income generating area. And so suddenly R&D became something in which they were very interested. At the same time, we then began to look at what they could do just to lower their tax liability by virtue of purchasing tax credits that came online post-Inflation Reduction Act. They were energy tax credit related. And that was just a new offering that we worked on with this particular company. And then at that point, we really began to like look at it with other companies that were out there. Then moving on, there was state credits in the sense component. Melinda, maybe you want to talk a little bit about that for a moment?
Yeah, sure, Marty. So we noticed they were paying quite a bit in a number of few states, and also we took a look at their footprint and also noticed that, they have expanded one of their locations in Tennessee. So based on that, we're able to get a big refund back for them. And also in Tennessee, in the past couple of years, there was some disaster, and we're able to get the federal disaster credit as well. And this is all based on their job creation employees.
Yeah, and so that was looking at both what they had done currently, what they could get in the past, and where they were going a little bit in the future as well, in terms of how we looked at that. And then the last thing, I think we also had the opportunity to look at some international tax and dividend repatriation, some transfer pricing studies as well. Maybe we'll just leave it at that. But the point here is that it's credits and incentives, it's overall ITax planning as well, state side of things too. And each of these things has a different drive upon like what's happening from a company, from a taxable income up, down, et cetera. All these things play together, and it's our goal to look at that, model it, and figure that benefit for the company and make sure they're taking advantage of every potential incentive that they have out there, and looking at the overall footprint as they do acquisitions and make sure that that's properly structured for purposes of overall federal tax and international tax. All right, polling question 1, everybody. Good stuff. Everybody, thank you for waiting. Okay, has your organization ever gone anything, shall we say, similar to a strategic tax review? Yes, no, or I don't know. And just to let you all know as well, I believe after this point, Louis and Laurel and Brian are going to leave us, and you will be seeing them in later sessions, modules of our Strategic Tax Advisory virtual summit later this week. I just want to thank them for being partners in this endeavor and bringing it to clients, but also for participating in this particular session for everyone today. So thank you guys so much for joining. I know you're busy and you're going to talk to many of our clients later, so I certainly appreciate it. We're going to release the results of this polling in a second, and we'll see how that goes. Okay, has you undergone a strategic tax review? Yes is 90%, no is 49%, and I don't know is 23%. So it definitely is something that we'll keep an eye on. If it is here's the point. If it's something that seems of interest to you, we're going to have limited slots, I think, as we look to identify who we can offer this to, or at least at first. But I would just say, if you have any interest that seems valuable, please let us know. We're more than happy to work with you to see here. So thank you. And that's polling question 1. All right. All right. Now we are going to talk, both me and Vivian Kors, who is a director in our Tax Credits Incentives Advisory Group, who joined us almost 3 years ago after being at Big Four. She's the director in the group. She's excellent at her job. Certainly has helped our group grow, and I think more importantly, helped our group offer high quality analyses to our clients with whom we work. And so I think it's been great for purposes of working well with our clients, especially in this time when Section 174 rules changed and everything we did around R&D credits kind of had a dual purpose or dual effect as we thought and how we added value to our clients. So with that said, quick high-level things that we're looking at when we think about a company that may or may not have R&D. We are obviously focused from a, call it hot topic perspective of whether or not they have capitalized the expenditures specific to R&D, which are no longer currently deductible beginning in 22. It's just the biggest deal that's ever happened, I'd say, when it came to like the research credit regime. This non-immediate expensing of R&D. It takes a lot of planning to think about this timing of amortization that if this 5-year amortization that hits when you have to capitalize, you need to figure that out against what your tax liability will be when that amortization is going to really hit and potentially get close to something that offsets all the expenses in the future. It's a modeling exercise combined with looking at the overall where you look at the credits too. But that's the biggest deal I think going on right now in R&D. The second though is what we're seeing from an IRS perspective around the requirement to disclose when you file an amended return, and in the future, when you just file for a research credit, what needs to go on the actual form and what needs to be disclosed to the service before they even begin an examination or in an amended return capacity before they will even like allow a return to be examined. There's certain disclosure requirements that we're going to talk about that are fairly new when it comes to retroactive studies and up and coming when it comes to current studies. Obviously, the other thing that changed under the Inflation Reduction Act was the amount of R&D credit that could be elected to be utilized against payroll tax beginning in 2023. It moved from 250,000 of credit per year up to 500,000. So for startup companies that have employees, and to the extent they can generate a research credit, it's certainly worthy to make the election to utilize that against your payroll tax. That needs to be done on a timely filed return. So this payroll tax monetization has only been around for a little bit less than a decade. And it's clearly of benefit to startup companies who have 5 million or less of gross receipts. It's really designed for small companies. But with that said, that's one of the hotter topics and one of the drivers of our services. The last thing too is just if you're a company who's thinking about like looking at what you did from an R&D perspective and you haven't claimed anything yet, look now, don't wait. Even if you can't use the credits, there are certain elections into which particular credit method of calculation you are allowed to use, and you might only be able to go back 3 years to elect from one method to the other if that would get you a larger benefit to get carry forward credits coming forward. I would just say this is one of my arguments to let us take a look and see exactly what could have been claimed and what years are open and what elections can be made. Last point as well, I think my particular hot topic, but I have seen a number of companies starting to move away from some of the contingent fee providers that may charge 30-35% of the credit. I think these disclosure requirements are putting clients in the mood that they actually need to take and understand. They need this to be well documented. And so I think working with sort of a full service accounting firm is better. I also think our fee structures are significantly better than contingent fee providers. We're also not incentivized to like get a high credit and charge a high fee. And we're also quite cognizant of what the capitalization requirements are. So yes, you may get a credit for what you're paying, but you're also in the immediate term going to have an increase in your taxable income as a result of the capitalization requirements under Section 174. So all these things play together with a more holistic view, I think better documentation to meet the disclosure requirements and an overall better fee. So that are the areas where I think we're focused right now in the R&D world. R&D credit, dollar for dollar reduction of your tax liability. It's been around since 1981. To the extent you're owned in the private equity context, you can still be eligible for credit. The control group rules do not necessarily cause every portfolio company within the private equity context to be treated as one company. And there's two methods to calculate this thing. Goes back to about 1989, the traditional credit calculation. And then beginning in 2007, there was an alternative simplified credit calculation that came about. And so that's what I'm talking about when it comes to looking at which method of calculation makes the most sense for your organization. Just really quickly, what is R&D for this purpose? Because a lot of companies think it is something like just very high level white lab coat R&D. It really isn't. It's much more broad than that. We're really focused on identifying companies that are developing new or improved products, processes, or software designs for the most part, where you're looking to improve the function, performance, or reliability or quality of that business component, of that product, process, or design. To the extent there is technical or computer science or physical science uncertainty with respect to the capability of method of getting that done, essentially utilization of those endeavors, those hard sciences or computer science, to the extent testing is involved, it's almost a de facto process of experimentation. So we're really focused on the development of products, processes, and designs. Who at the company is spending their time working on identifying and eliminating that uncertainty and associating those activities with different projects at the company so that that may go into a research credit calculation and can be documented. Just from an overall perspective of what we look at when we look at these things, their information request is focused on getting the box 1 W-2s of the people who may be performing R&D, or really the whole organization, so we can map out where R&D is or is not occurring. Also, the general ledger to take a look at what supply costs may be used in the research process, what third-party contractors may be involved, and also just any amount of extraordinary utilities or cloud hosting expenses, and also just generally what other expenses may be somewhat peripheral to this, but may be required to be capitalized. Okay, so with that said, this is the same thing. This is just our information request. So good thing I put it in twice. All right, so everybody can really focus on what we're going to get, but this is a more detailed version of it. 2 methods of calculation. I don't want to get too deep into this, but one, the US credit is an incremental credit, meaning that you're looking at what your spend is in the current year versus what it is at some period in the past. And so it's the credit for increasing research activities, and you have the option to look at some amount of research spent in the past as a percentage of what your overall sales were in that time, or just look at what your research spend and how it's been trending over the past 3 years. You have the option to look at it either way, and you can elect in and out of it year over year. But I would say most companies are focused on this alternative simplified credit and just looking at what their spend is year over year, looking at the average of the spend in the prior 3 years. 50% of that average is a base amount, and then to the extent your spend exceeds that base, that's the amount that's credit eligible in the current year. And so that's just an analysis and a little thought piece as we work with new companies. Those that are in the startup mode, the traditional method generally works better for them and yields a higher benefit, but we'll look at it either way. All right. Polling question 2. See, I told everybody it would go a little faster and you'd have some questions to answer. So with that said, do you utilize a professional firm to have an R&D study performed? Yeah, I think a lot of companies do it in-house. We've seen that. We see companies that have worked for a long period of time with a lot of times the contingent fee providers. I think as these companies mature, I have seen them begin at that point to work more with, shall we say, more trusted CPA firms. It's just some of like the consultancies out there that do R&D and nothing else. It's hard to do an R&D study in a vacuum without any other appreciation of what's going on with respect to the overall return and how valuable that may be, especially considering that R&D expenses are now capitalizable. And so with that said, that's just sort of the trend that I'm seeing is more companies sort of coming out of the CPA side of things. Okay. The answer is we do, we don't, and we do it in-house. So excellent. All right. Okay, let's talk about disclosure, and let someone else speak. Vivian, you experience this every day from me, but again, please take over and
Every day. Well, thank you, Marty. I feel like my whole entire trend for this entire discussion will be around disclosures. So disclosures, and have I mentioned disclosures? So starting October of 2021, the IRS issued a Chief Counsel memo that essentially required additional documentation as part of a disclosure for amended refund R&D claims. So to the extent that you're filing an amended return to request a refund as it relates to R&D tax credits, you are now required to disclose additional information related to your business components, all the research activities that are performed, essentially how your folks were performing, who your folks were performing research activities, and the information that they seek to discover. Originally, there was a grace period through, I believe, January 10 of 2022, where a 45-day letter would be issued to correct the claim if the disclosure was not included or there wasn't enough information, as the IRS deemed after their review, as part of that disclosure. However, that has been the grace period has been extended multiple times, and the latest extension is through January 10th of 2025. So you still have that time, roughly half a year, to take advantage of that grace period so that it's not outrightly rejected. And then the latest change has been around the IRS reducing some of that burden, as they would like to say. So on June 18th this year, the IRS essentially crossed off the requirement to disclose the names of the individuals who performed each research activity, as well as the information each qualified individual sought to discover. So you would still need to disclose the business components, the research activities that were performed, as well as the qualifying research expenses. But they did reduce some of that burden on the taxpayers by reducing the requirements and removing the requirements for the list of folks for performing research activities. And Marty, can go to the
one
next.
point here. Yeah, just one point here. This happened, I think, because the IRS was, I believe, going through almost in some ways a lighter version of what they experienced with the employee retention credit. A number of large contingent fee providers were putting a variety of R&D credit claims in and just hoping they wouldn't get examined. and then, at least that's my suspicion. With that said, what the IRS then did was said, look, if you're going to do an amended claim, you're going to at least have to like do some baseline amount of homework and disclose to us up top like what this thing is about. So we're not just looking at numbers. We want to have something to at least help point us in the direction, and then we can let it go through the gating process of the overall audit. This 45-day thing as well is especially important, or was, to the extent you had a company that was going to, you did a multi-year study and the statute limit, you filed it, and then the statute of limitations passed for like the earliest year. Instead of getting just rejected and losing that statute, you had 45 days to cure that. That's gone now. And so you really need to be cognizant of those statutes of limitation.
Well, they extended that through January 10th of 2025.
They'll be gone then. Okay, fair. Yes. Great. What I meant to say. Excellent.
So there has definitely also been exciting news in the R&D world. So again, June 2024, just last month, the IRS released proposed changes to the Form 6765 that will be effective for tax years beginning after December 31st, 2024. So really your 2025 tax year. So the majority of the changes around this was again, disclosure of additional information. So previously, your Form 6765 was really a quantitative look at your R&D credit. So, hey, what are your qualifying research expenses? What is your base qualifying research expenses? You know, multiply XYZ, you get to your credit. And that was it. However, this proposed changes are really trying to get to what the Chief Counsel memo is also trying to get to, right? So what is your business component? That's one of the bigger changes is they require additional information. And sorry, Marty, if we can go to the next slide, it kind of shows you, well, actually maybe the next two slides. It kind of shows you the changes around section E, F, and G. So section E asks for additional information that is around whether or not you have acquisitions or dispositions. That's something that they never asked before. The number of business components that generate your qualifying research expenses. That's also something they never asked before. Wages attributable to officers that you're claiming. and whether or not you're using ASC 730 directive to calculate your qualifying research expenses. Section F, which basically breaks down just your quantitative side. I don't know why they decided to separate out that reporting, but either way, that's a quantitative analysis and that's not the heavy lift. Section G is where I think taxpayers are going to be, I guess, maybe more shocked by the changes that are here. So taxpayers have to provide controlled group members. They have to provide business component names, type, information as to whether or not software is being developed, what the qualifying research expenses are by business component, further breaking out between who is performing direct research, who is directly supporting, who is directly supervising. These are all new information that the IRS has not asked for before as it relates to Form 6765, but we are seeing a trend that the IRS is seeking more and more information up front as opposed to, trying to get more exams to get that information. Another change is, as Marty mentioned before, qualified small businesses get to utilize their research tax credits to offset up to $500,000 of their payroll taxes, which is definitely new and exciting. Previously, it was capped at $250,000. Oh, and I'm sorry, that is one of the next slides. And in addition to situations where maybe you don't have a tax liability, and sorry, Marty.
Yeah. No, I was having, they're a little laggy. Sorry about that.
All good. So for companies who don't have an income tax liability, the federal credits can be carried forward up to 20 years, but obviously a lot of taxpayers are, hey, I want cash now, cash is king. In addition to being able to offset your federal credits against your payroll tax liability, certain states offer you the ability to sell your credits. Virginia R&D applications allow for a refundable credit. Georgia, you can elect to utilize your Georgia R&D tax credits against your Georgia payroll tax withholdings. So there are a variety of ways where you can monetize your tax liability, and that's definitely something that we can help and look at. And then lastly is around federal payroll tax monetization. You can only use this up to 5 years. And essentially all members of the control group cannot have more than $5 million of gross receipts in the current tax year and cannot have gross receipts back to more than 5 years. So basically, if we're looking at 2023, you basically can't have gross receipts in 2016 or 2017. I think with that, I believe we have polling question number 3.
All right. So, does your R&D process collect information necessary to fill out the new form 6765? Keep in mind that, prior, and by the way, this begins for the 2025 tax return, right? So we've got another year until this happens, but mostly this documentation was collected for just in preparation for a potential audit that may or may not happen. The benefit of doing a true R&D study where you're allocating your costs to specific business components has value for the immediate need to have it reported in a way that will be accepted by the service. So I think what we do from an R&D credit perspective not only became more important when capitalization hit, so we could understand that and make sure we minimize that, but now all the documentation really is so important just for purposes of getting that thing filed correctly. Again, those are the 2 hot topics: disclosure and Section 174 capitalization. So with that said, there we go. Yes, no, we're happy to talk to the no's. Without a doubt, to the extent you needed any help with respect to additional documentation in preparation for what you have going forward. So everybody, thank you for taking part in that poll. We're going to keep moving on here with Vivian, and I am very hopeful that my computer continues to cooperate with me and move ahead along with her. She's definitely faster than my computer. Okay, with that said, Vivian, maybe I'll just talk a little bit here about 174 and leave it to you. The requirement to capitalize R&D expenses became into law in late 2017, but didn't take effect until 2022 for calendar year taxpayers. During this period from December 17 until January 1st, 22, and maybe even after, the expectation was always that Congress would likely delay their need to capitalize to a later time or change that requirement altogether. This was really just put in as a pay for to allow the scoring to work appropriately for the reduction of the corporate tax rate from 35 to 21%. Nevertheless, it was never delayed nor anything other than came into effect, much to the surprise of taxpayers and some tax practitioners as well. And so I saw a lot of, again, providers that didn't really warn their clients about the fact that this was going to happen or set false expectations that it may go away at some point. And so it just kind of delayed the developing the process to identify what needed to be capitalized or not. I'll leave it at that somewhat, but in 2024, there was legislation passed by the House in January to eliminate the capitalization requirements for domestic R&D and have it kick back in 2026, but keep it for foreign. That didn't pass, and so I don't know if much will pass. There are, without a doubt, a number of developments weekend after weekend when it comes to this particular election and politics right now. So I think everything is up in the air, but definitely legislative agendas are probably the least important thing going on right now with this election. They'll be talked about, and I expect something to happen one way or the other after the election, but before, I would be surprised if we got any substantive repeal of the capitalization requirement under Section 174. Maybe you want to start here? I think I said I was going to, but I can.
All good.
Yeah, cool.
So basically, the Section 174 is the requirement to capitalize, as Marty said, and the Congress kind of introduced a new term, SRE, so Specified Research and Experimentation Costs. And that's kind of what is being defined in the various section of Section 174. But really, it's if you are trying to do research and experimentation, trying to solve a technical unknown, and most importantly, if you are performing software development, and we can go into that a little bit more detail later, but if you are performing software development activities, you do have Section 174 costs that you are required to capitalize and amortize. And if we go to the next slide, I think it has a nice visual of kind of the interplay between Section 41, which is R&D credit, and Section 174 costs. So when we were just talking about R&D tax credits, the various costs that Marty was mentioning, wages, W-2 Box 1 wages for folks doing R&D, your supplies, your third-party vendor costs who are performing R&D onshore, that's kind of your subset, your starting point of your Section 174 costs. Section 174 is much more expansive than that. It's basically all costs incidental to R&D, and it is broad and it is meant to be broad. So not only does it include gross wages as opposed to W-2 Box 1 wages, it includes foreign costs as well, which needs to be capitalized and amortized over 15 years instead of 5 years. And for the credit, if you can see in the top left-hand corner, your contract research expenses had to take a 65% haircut to be included as part of the credit. You're taking that at 100% for U.S. contractor costs. Furthermore, we can get into that a little bit more. There are also funded R&D costs, other overhead costs like depreciation for the property in which you are performing or on which you are performing R&D. There are software licensing costs and general overhead type rent type costs that need to be amortized, capitalized and amortized. So that's all part of Section 174 SRE expenditures. Administratively, it is technically a method change to capitalize and amortize. So most taxpayers previously would be timely expensing your specified research and experimentation costs. Although it is required, it is still a method change and unfortunately quite burdensome. So for your first taxable year after December 31st, 2021, you could file a disclosure statement, essentially expressing your intent to adopt the method change, the automatic method change. However, if you're past that first year and you did not include that disclosure, you are required to file a Form 3115 to adopt your method change to capitalize and amortize your research and experimentation costs. there are several interesting instances that we've run into that also require you filing a Form 3115. So what we've seen, obviously, in addition to folks who did not capitalize in their 2022 tax year, are folks who maybe under or over capitalized in 2022. You would think, hey, I already filed a disclosure statement. I already adopted a method. But unfortunately, because you are changing the characteristic of your expenditure, you would still have to file the 3115 to kind of either amend your overcapitalization or undercapitalization. So that's all pretty fun. You do not get audit protection for your automatic method change for this particular method change. So that's something that's important. It is a potential area of risk for the underpayment and for the underpayment of your tax. And then Marty, if we can go to the next slide, which is one of my favorite slides. So in September of 2023, yep, right before the extended timeline, the IRS is like, finally, we're going to release some guidance around Section 174 that you've been all dying to get your hands on. This has been at least helpful to me because it does show, hey, it does define what is software development activities. It does talk about a lot of the areas around research performed under contract, which could potentially lead up to double capitalization. That's one area that I know a lot of taxpayers were contemplating and trying to figure out, and it does impact professional services in your government contractor or your government contractor type companies. So it's definitely helpful guidance in that sense that it does talk about that. The main ones that we want to discuss here would be really around the types of costs that fall under software development. And sorry, Marty, can we jump like maybe 2 slides down?
Yep.
So really your software development, you kind of think of your software development lifecycle, right? Anything from planning to designing, architecting, actually writing code to pre-production testing. That's all software development. However, the guidance does clearly state what activities are not considered software development. So to the extent you're training your model, to the extent you're providing training on the platform that you developed, or if it's maintenance, and this includes bug fixes where it does not arise to the level of enhancements or improvements to your platform. So I think that's a big thing that we can carve out and reduce your Section 174 costs if you were previously considering capitalizing that. Any data conversion costs, straightforward implementation, installation, and most importantly, production costs are not included as software development. So I think it does provide additional examples in Notice 2023-63. So I do think it's definitely helpful. And then last but not least, it addresses research performed under contract. So as part of the R&D tax credit, I know we didn't get into it earlier, if you are getting paid to perform R&D, you actually have to bear the economic risk and retain the rights to the development. So it's an and test. It's a more stringent test, meaning there are potentially activities that you are conducting on some of your funded research that is not R&D credit eligible, but is still 174 capitalized, required capitalization. So examples of this would be, hey, we don't necessarily have the rights to the development, but we are being paid on a firm fixed price, and there's milestone payments where there are acceptance testing, XYZ. So you bear the financial risks and the economic risks of the qualified research activities. That would mean that the activities, to the extent they are specified research and experimentation, the costs associated with that would still be your 174 costs that you have to capitalize and amortize. Another fact pattern of that would be, hey, I'm being paid time and materials. And I don't bear any risk. I'm basically just a warm body that I'm here to provide services. However, I retain the patent rights to whatever I'm doing, for example. Because you retain the rights, even though you do not bear the economic risks, you still have to capitalize and amortize your specified research and experimentation costs. So the Notice 2023-63 does provide further clearance around know-how. So just mere know-how does not arise to the level of having to capitalize. So that's good. That's taxpayer friendly, essentially. Anything else you want to add, Marty?
Always. So let me ask this polling question, then I'll add something, and then yeah, we'll close up on the R&D side. So in 2022, did your company capitalize qualified specified research expenditures in conformity with Section 174? Yes, no, not sure, or not applicable to us. The only thing I want to add is that once these rules changed, we came across tax practitioners and clients who suddenly had been performing R&D forever, and then suddenly were trying to provide the facts that their business doesn't do any more R&D, so that we're just not going to claim a credit, and therefore I don't have to capitalize. I don't want to do this. I think it's the wrong way to think about it. The credit is elective, the capitalization is mandatory. And so I think it's incumbent upon all companies that are developing new products, processes, or software designs to do their best to minimize that capitalization. But if you're not looking at it at all, it is likely you're potentially exposing yourself to something with the IRS. It is only a timing difference, but it's a 5-year timing difference. Real quick, did your company capitalize? Yes, no, not sure. We'll see how that comes up in a second. Anyway, the point is, don't be afraid of it. Take a look at it, model it out. If you have to capitalize, you might as well get those credits as well to minimize and offset that. And then look at some other things as opposed to taking a tax position that really isn't supported in the law and just kind of blowing off the capitalization and not claiming a credit when nobody looks at it. I think there's so much more that can be done for companies. And that's kind of why we're here, to talk about this strategic tax annual review. This capitalization is a big deal, and it's driving a lot of the other opportunities or things we pursue to reduce the overall rate or the cash outlay. We'll see how this polling question comes up. But with that, I just want to say thank you to Vivian for joining. I only called her an hour before this thing started and said, hey, by the way, would you like to do this with me? And so I appreciate her jumping on. We do a lot of these, but I certainly appreciate her participation today. And if you need to go, we will no longer be covering R&D on this, so we can move on. All right. Okay, I'm going to talk Inflation Reduction Act at a high level, and the reason at a high level is due to, yes, Vivian, thank you very much. You're getting claps. Is due to the fact that on Thursday, we're going to have a more in-depth Inflation Reduction Act session where we Will Billups from our tax provision services group, David Moamani, who works in tax credits incentives advisory, who has a long history around tax equity modeling pre-IRA and now sort of post-IRA world, working with companies who are placing into service certain projects, or working with our clients at the firm who are looking to assess what credits are available for purchase out there. Again, Inflation Reduction Act passed in 2022. Instead of having like we did, a sort of patchwork of temporary incentives that were winding down around solar and wind, et cetera, we have incentives that are stable for a 10-year period until 2032 that also require additional documentation maybe than they did in the past. So the technologies and number of technologies that were credit eligible were increased. The credits themselves, to the extent they are generated by a taxpayer who does not have a tax liability, can be sold on the open market. Certain not-for-profits and governments, not federal government, but governments in the US who typically could not utilize the benefit of a credit became eligible for what's called the elective or direct pay regime. 2 times over, certain manufacturers of green widgets or those that were improving their manufacturing facilities to reduce greenhouse gases or to create a facility to refine critical minerals, the investment in that facility could have been eligible for a competitive application-based credit under what's known as 48C. 2 rounds of that have passed already, and an allocation out of 10 billion in credits was done. There are now manufacturing credits for the production of clean energy components, which is a production tax credit, which takes place as those are sold. But Also, there's additional documentation because certain credits only reach their maximum statutory rate to the extent prevailing wages were paid to the laborers on the project, and apprenticeship program was in place. Additional enhancements are eligible to the extent domestic content is utilized if it's placed in an energy community or a low-income community. So the credits themselves may have just a base statutory rate of only 6% as opposed to 30, but the more of these, like for example, you have prevailing wage and apprentice, it goes up to 30, and then maybe beyond that too. So there's a lot to look at, and a lot we will discuss on Thursday. I think Inflation Reduction Act and 174, as we talked about, the two most federal tax credited game-changing things I've seen gone on that's hit my group. But we will talk about it more in depth. But for those that can't attend, I just wanted to make them aware that when we're looking at our analysis of a company and we're thinking about an overall strategic tax review, without a doubt, the Inflation Reduction Act was game-changing and is top of mind when we're thinking about what that company is doing. We're always looking at where they're making investments or what their corporate structure is, and to the extent they are a C Corp, they may be able to take advantage of the purchase of credits to lower their tax liability. Additionally, we'll work with companies that don't have a tax liability and may be selling those on the open market, and so we'll document those credits. I'm going to skip through this because we have a lot to get through. I talked about this as well, but the IRA did create a new mechanism under Section 6418 to allow entities, 6417 and 6418 for both transferability and elective pay. Again, when it comes to these enhanced incentives that are now available, the ability to get a direct payment from the government if you're a not-for-profit, or the ability to transfer that credit on the open market is clearly game-changing, and it eliminates some of the marketplace and need for tax credit equity transactions. I would say, there were 5 or 6 large sophisticated taxpayers who did most of the tax equity transactions for solar and renewable credits and things like that. It's now opened it up to a wider number of individuals who can participate in selling and buying credits. These are just a listing so you can see exactly some of the credits that were added from the Inflation Reduction Act. These are those that are transferable, and 48C is specifically in red because it's past date, although you may see 48C credits come online and be sold in the marketplace to the extent clients get their allocation of credits and they won that competitive application. But the ones in green are the ones I think we deal with the most, at least right now. Again, here's just the overall eligible technologies. We're focused on fuel cells and solar, geothermal, standalone energy storage, biogas, wind, combined heat and power systems, even in large manufacturing facilities. That's been around for a while, but was extended. Municipal solid waste as well. Again, the difference between an investment tax credit and a production tax credit. Investment tax credit, you have a credit calculated based on the essentially basis of the qualifying property that's placed in the service in a particular year, and that credit becomes available when placed in service. Production tax credits are earned over time as certain amounts of energy are produced, or certain amounts of products are produced over a period of time. And so it's two ways to look at a credit. Some technologies are available to look at both, but we're focused on all of them. So with that said, and before we get into my introduction to another team member, is have you considered benefiting from any of the credits in the Inflation Reduction Act? Yes, no, or I don't know. We'll leave it there with respect to the IRA. But Glenn, I don't know if you want to turn your camera on right now and say hello. We're going to talk a bit about incentives eligible. Well, we're going to talk about cost saving 179D, but we're going to talk about incentives available in the real estate construction space and what some of the trends are right now. Glenn Lemieux just joined us in April 17th, I believe, and he has added quite a bit of value to our service. He joined us as a director, and I wanted to make sure he had the chance to introduce himself to this group and talk a bit about what's going on in the marketplace for cost saving and 179D stuff.
Awesome. Thank you. Happy to be here today. Yeah, I'm new to the team, but not new to cost segregation. So I've been in this.
I asked Glenn 5 minutes before this conversation if he would be on this one too. So I have to give credit to my team. Jumped on a dime to be on this thing. So thank you.
Had to get the iron out today. So yeah. So no, I'm real happy to be here, and hopefully everybody's gotten a lot from the the previous parts here. So I'm just going to talk about, with Marty's help, cost segregation today. And cost segregation is kind of the out of everything we talked about today, one of the easier things to identify. So if you own a building, commercial or residential, and you're depreciating it at 39 or 27 and a half years, you probably should look at a cost segregation. So essentially, a cost segregation is a strategic planning tool where we're accelerating the depreciation, which leads to deferral of tax payments. So this is particularly beneficial in the early years of a project because it's typically most beneficial in the year the project was placed in service. But what the nuts and bolts are is that we're looking at a just commercial building. You're depreciating over 39 years. What we do in the study through engineering and through IRS guidelines, we break the building into components, and these components are allowed to be depreciated faster. So typical 5, 7, 15-year components are 5-year personal property, carpeting, cabinetry, 7-year could be building lighting, 15-year of the land improvement. So we break those into the specific buckets. And then there's bonus depreciation that is in play. And we'll show a slide later of what bonus looks like. And it's actually going away after 2026. Hopefully it doesn't, but right now it's set to. So that's really what the study encompasses. So the building can be acquired. The building can be constructed. So one of the changes a few years ago was that bonus is now eligible on acquired properties. Before, it was only new construction or originally used properties. So another great thing about cost seg studies, you can do look backs. So if you had a property that's placed in service a few years ago, we can pull all that depreciation through the cost seg study. We can pull all that depreciation into the current year by using a simple form 3115. It's a method change form. So that's kind of the real nuts and bolts. And then, here at Cherry Bekaert, having some experience in the industry, we do a really great job of working with other folks in the tax team. So we're not on an island. We're not doing this by ourselves. So part of the study, we're looking at identifying some of the other credits, some of the things that Marty just mentioned, other deductions. We can look at fixed asset schedules if something's in service already, and we can say, we can make some judgments on help you. Maybe that should have been expensed and not capitalized. So things like that. And then obviously some other benefits, potential personal property tax and real estate opportunities. So you can go on to the next slide. So here's like a typical example of a cost segregation study. So this is a commercial building. I think it was an office building. So the purchase price would have been 3.9 million. So we'll assume that is the basis of the building. The land has already been removed on that. So if we do nothing with this building, if you own this building, you do nothing, you depreciate it over 39 years. You're essentially taking 1/39 of the purchase price over the next 39 years. And then at the end of 39 years or the 40th year, you'll have no value in the IRS's eyes of the building. If you look to the column to the side there, that's what a cost segregation study can do. That's the impact. So what we're doing the study, we're pulling out all that personal property, we're pulling out the land improvements, and we're allowing that 1.24 million to be depreciated, accelerated. So that could be quite a benefit in the first year. So hopefully if you're paying some taxes, that will ease your tax burden. Second year, there is also some valuable depreciation had. But typically, because we're pulling everything in that first year and because we're applying bonus, the second year depreciation can be less than what it would have been without a study, if that makes sense. Just because you're actually giving a little depreciation back on the 39 year versus pulling it all forward on the shorter years. So next slide is what depreciation is doing here. Unfortunately, we're set to zero out depreciation in 2027. There's been legislation floating around out there that was approved by the House and never got to the Senate to put depreciation or put bonus back to 100%. Unfortunately, that got nowhere, and it's probably not going anywhere until early next year or next year.
It's the same one that the 174 is in there. It's the same one that the employee retention credit elimination early was in there. Imagine working in a tax credits and incentives group where the legislation is always pending and never quite there. It's been an interesting year or two. Yeah.
Yeah, and the math is so much easier at 100% bonus. I mean, that's my big thing. But no, it's hopefully something gets done on that, because it really does help the decision process when acquiring new buildings, and also investing in new construction. So that is cost segregation. So also in my group, one of the other things that is a hot topic right now is a commercial building energy efficiency deduction. It's a section 179D. And it's basically for newly constructed or significantly renovated buildings. And it's a deduction based on, prior to January of 23, it was solely based on interior lighting, HVAC, and building envelope. And we'll talk about this in a minute here, but post Inflation Reduction Act, that now is a more of a, it's an all-inclusive deduction that they look at all three areas and it's weighted and things like that. Before, it was strictly 80 or 60 cents per square foot. So now after the 22, it went from $1.80 max up to $5 a square foot. So some real benefit there. Again, this is a deduction. And so it's in the year that it was placed in service. So much like the cost segregation, we can do look back studies on buildings that could be eligible for 179D. And again, it's a simple form 3115 that you file with your return. It pulls all that depreciation into the current year. So it's a great benefit. And if you have a new building, it's something you really should look at. So new for 23, we'll talk about this next, but it can be profitable for not-for-profit. And, before the Inflation Reduction Act, basically you had to be a taxpayer to get any kind of benefit off of 179D. So that's all changed. So the next slide, we'll get into some of the IRA changes here. You want to move on there, Marty?
Oh, do you not see it anymore? Am I not sharing my screen? Did it go away?
Nope, there it is. Okay, yep, had a little pause there.
Oh,
so
no problem.
just some effective January 1st of 23. So these are the IRA updates. So now the eligible buildings before were really government buildings, and now they've included some not-for-profit. So the examples: charity hospitals, churches, private schools, public schools. Prior to the Inflation Reduction Act in January 1 of 23, you could only do government buildings if you're looking for a 179D allocation. So 179D, you can do that. You can take that deduction as a building owner, or if you are a designer, you can get allocated the deduction from the non-tax-paying, your non-tax-paying client. So before that was just government entities. Now all of these not-for-profits are included. So another caveat that was added, and it's a great thing, is that now you can take the deduction every 4 years. So if you do major renovations on a frequent basis, before you do one and done, and now you're allowed to do, you could refile for 179D based on major renovations or additions to building. One of the big impacts of the IRA was that the deduction increased substantially. So prior to, again, the date that we keep referring to is January of 23, 100,000 square foot building could potentially have that $188 a square foot or $188,000. So now with the 536 per square foot, you're up to $536,000 for the same size building. And that $5 is it's adjusted for inflation. So the 536 is inflation for 2023, and it'll go up every year. But of course, that doesn't come without any caveats or without any kind of requirement. So to meet the maximum benefit of $5 and $5 or $5.36 for 23, there are prevailing wage and apprenticeship requirements. So I think the goal of the law was to try to encourage getting more people involved in the construction side. I'm not sure if that is happening or not, but the good thing is that there's some good faith exemptions that you can do. So if you are on a project and you tried to get apprenticeships and there's just none in the area, you can get an exemption for that. One of the real sweet spots for this new law is there's a grandfathered clause, if you will. So if you started any construction prior to this date I keep referring to, January of 23. So you had significant, so you moved some earth, you had some building going on prior to that date. You can qualify for the $5.36, so the higher deduction, without having any of the prevailing wage or apprenticeship program. You can get the higher deduction without having any of those things in place. So it's kind of a sweet spot. And we've run across quite a few people. There's not a whole lot of projects that were placed in service in 23 and even up until now into 24 that didn't start prior to January of 23. So there might be some added interest in that. So.
All right. So I think that's about it in terms of where we are in real estate and construction incentives right now. Again, Glenn covered the ability for not-for-profits to allocate the 179D. Also, I mentioned it earlier that direct pay is available to not-for-profits as well in the Inflation Reduction Act credit space as well. With that said, at this point, you can tell we will have this as takeaway. You can see sort of the eligible investments and what's available for certain investments in. People are asking renewables or sustainability or what my overall carbon footprint is. These are things that are affecting of that, and incentives and credits come along with that, or direct cash payments. Polling question 6. Is it best to investigate the Section 179D energy efficiency deduction before the new building is placed in service? True, false, or not sure? I think we can, you can decide, but I always say the earlier the better to take a look at that for planning purposes, to see what's out there. Also, to the extent something has been placed into service and maybe an engineering firm is doing it for, and they're one of many engineers on a particular project, and they have the ability to be allocated the deduction as opposed to somebody else. Get on it earlier to get that allocation letter given to you, or at least split with some other contractor out there. We are just about finished. The rest of this, we have 2 minutes, and I think we can do it in 2 minutes. We're just going to talk a bit about some advertising, shall we say, for the rest of the sessions. I'll get to it in a minute, but Melinda, just I don't know if you want to jump back on and say what you'll be covering later this afternoon.
Sure, Marty. So later this afternoon, I'm going to give you an overview of our site selection process, and also how we negotiate incentives to help you maximize your, reduce your production costs and help you maximize your cash flow.
Absolutely. And then on Thursday, we're going to talk quite a bit about transferability and what we're seeing in the marketplace, what the credit prices are, what kind of clients and taxpayers it can apply to, what the different technologies are and how they're priced, et cetera. So I think it's going to be very exciting for those that are looking to purchase credits. And finally, Laurel Tindley is going to talk a bit about the practice around new markets and some of the financing services. With that said, we are 1 minute until. I hope you all answered the polling questions. I appreciate everybody who stuck around with me today while, as I look at myself in the camera today. This looks very much like an outfit I wore to my first high school dance in 1984. So I do appreciate everybody putting up with that. I want to thank you all for attending. And I just want to say, mostly, to the extent a strategic tax review would be in your interest, just reach out to me directly, and I can get our partners together to and a number of people from our practices to request information and really begin the process of taking a hard look at what you have and how we can affect your tax rate or get you cash. It is our goal to serve the middle market with all the skills of everybody at Cherry Becker, whether they've been here for a long time or new to the place. It's an exciting firm at which to work, and I know we can offer a lot of value. I just want to thank everybody for joining today, and that's it. Take care.